Okay, folks, welcome back. This is our weekend review and final market review for 2019. As I indicated last recording and leading up into this coming week, I will be taking the week of Christmas and the New Year's week off. I will be posting charts on the forum for Wednesday and Friday, but I won't be doing any video work. Okay, so keep the expectations light. It's the holidays. We're not at a time where we need to be in the marketplace expecting every little minute move. All right, so the dollar index is our daily chart. All right, so I had our focus on this last up close candle that was driving back up into the 2018 high, which is this red line here. So all of this is 2018 annual high. We rejected that. It ran lower for the sell side liquidity as we were expecting. Had a really nice run off of the fair value gap and sell side liquidity over here. Price has not shown a willingness to go into the order block and sell off. And if you look at the the open price on this candle, which is what we were looking for relative to that candle, the open is 97.38. 97.38 on today's low for the dollar index. We had that very low hit, or that opening price. So again, swing highs. We're looking at the open, high, low, and close. I tell you to look at those specific price points. They're not random, they're not ambiguous, but you'll be looking for confluences of things to support a buy or sell or continuation if it's broken. Ran back up into the 2018 high, and so far we haven't closed above it, but this liquidity pool is so close to where we're at. I mean, you can still punch up there and grab that and finish out the week, and also make an attempt to get up into this balanced price range. Now, if we get through this, then the buy side liquidity pool above here is the next upside objective. I don't think there's a lot of momentum one way or the other, bullish or bearish. We've basically moved right back to the middle of the range for the year. And if you look at the low here and the high, we're right back in the middle. So we're not in a position that would warrant a great deal of excitement or interest. It's going to be a wait and see to see what side they want to run on. When we were running into here, running this buy side liquidity pool, that set the stage for the sell side liquidity to be tagged, and that gave us the framework. Where we're at right now, nothing really sets up a high probability condition or low resistance liquidity run. So it's important to understand why we are sitting on our hands and not trying to force a setup, and also the time of year. Okay, the year is winding down. There's not a lot of money that wants to take on risk with just a few days left of the year. Any accounts or managers that have had money enter their account or basically make a profit, they're not willing to risk any of that. All right, so we're going to roll into an hourly chart on the dollar. All right, so here's our hourly chart on the dollar index, and I'm going to zoom in here just a little bit. Okay, and we can see Friday's price action here. This is the candle that created that low at 97.38, which was the old order block on the daily chart that we were looking for sensitivity on the downside. We ended up finding support here, and it reacted and rallied, going back into the 2018 highs. And again, this is that old high on the daily chart of the dollar index, and the buy side liquidity rested above that. Since we hit the fair value gap down here at 96.60, it rebalanced. All of this range came back down, and then, like I said, it's been repricing all the way back up to the 2018. So 2018's high has been swept one more time. Do we give up the ghost and go lower from there, or do we keep pressing higher for the buy side liquidity pool and then reject and go lower, or do we just stay in the middle, run the buy side liquidity, and just stay in consolidation for the remainder of the year? I'm going to say that's probably going to be the case. the last. In other words, not expecting a whole lot from the dollar index. And it's going to create some lethargic price action in the euro dollar, which we're going to go to now. Okay, so here's our euro dollar daily chart. And again, just really nice to see that buy side liquidity pool ran out, come back up, failed to get back above here. And I mentioned some fair value gap in here and a fair value gap down in here. We came down, filled in that, blew through mean threshold of the bullish order block, almost came down to the entire body of that candle, and sell side liquidity rests here now, and we have a pool of liquidity on the sell side below here. I just want to annotate this now because prior to the video, I wish I would have had that on there. I seen it, didn't annotate it, so I'm going to do it while I'm talking to you. Okay, we have a fair value gap here and sell side liquidity, so that probably will be the draw on liquidity, and it also supports the idea of running that buy side liquidity on the dollar index on its daily chart. So we might see that unfold. Again, not a whole lot of excitement. I do think that October holds the low for the year still, and anything that we get down here or run below these equal lows, I don't know. We'll have to see what we get and how we trade to it. Right now, it's a draw on liquidity, but we still also have just this in here. So it can come down, stab that, and then go right back in the range and work with the high that's formed here and whatever low forms if it runs below here, and leaves these intact, because the second low went lower than this one. So when we have that, in other words, we have a low, a lower low, and then we rallied, even though these are basically relative equal lows, sell side liquidity pool builds up in that, yes. But if this low were higher than this low, then I would feel more inclined that it's going to make a run for this, because we didn't get the lower low than this one, then rejection and higher, which is a characteristic and signature of a stop run. So they've already done the work down here. So for it to come all the way down here, it's a more meaningful decline, and it probably won't stop just below here. So I think that the tension really just should be here for now. And if it does aggressively sell off, then we have to consider these levels. But right now, it is a pool of liquidity. But right in here is our focus for any downside continuation from where we are right now. I don't see any bullishness at the moment. Okay, if we trade down here and then reject, then that might change. But for right now, I just think that this is the draw on liquidity for euro dollar going into next week, and it's going to be a very light volume week. It's the end of the year. It's the holidays. It is what it is, folks. So try not to have a lot of, like I said in the beginning of the video, keep your expectations very low. I told you I was going to keep these lines in here for this SIBI, sell side imbalance, buy side inefficiency, annotated from the low of this candle here and this high here. And I'm going to draw into the lower time frames, and we're going to see something interesting, exactly as I was expecting. Okay, here's the hourly chart on euro dollar, and here's the top of that SIBI on the daily chart, and this is the low of that SIBI. Didn't get quite down into the consequent encroachment here on the 18th. Did in fact get it on the Thursday, the 19th of December. And then we had a fair value gap right in here, which you'll see when we go into a lower time frame, 15-minute time frame, but you can still see it in here. And the 20 level, 111.20, and it happens to be the SIBI, top of the fair value gap on that daily chart. Remember, IPTA will remember these specific demarkers, and when price hits it, look at the bodies of the candles in here. Okay, I'm going to zoom in. And look how the bodies are respecting that price level right in here. The close on this candle is 111.22. And the open on this candle is 111.22. And I just want to go back out to the daily chart real quick. And this candle's low that makes that high of the SIBI. Let's see, get this over here. The low is 111.21 in 9 pipettes. So basically it's 122. Okay, 111.22 rather. When we drop down into a 15-minute time frame, you can see the fair value gap that exists in here and returns right back up into that old high for the CIBI on the daily chart. So between this level and this level, that's that fair value gap that exists on the daily chart. But look at the sensitivity here. Closing a fair value gap and immediately rushes going lower. And we try to get back above into the fair value gap here, and institutional order flow entry drill here rolls over. Fair value gap, institutional entry drill rolls over, goes lower. Institutional entry drill right here goes lower. Okay, so really nice little study here. If you want to break that down into a 5-minute chart, that's actually even more homework for you there. And now we're going to go to cable, wrap this one up. All right, so here's the British pound. This is our daily chart. And I mentioned on Twitter this week, I said, look where the largest pool of liquidity is on cable. Okay, I asked that rhetorically. And right below this low, we have the fair value gap in the form of a BISI. So all the liquidity was resting below this low here. Today's price action, yesterday's price action, Wednesday's price action. So Wednesday we have the daily high and the daily low. If we're expecting a run below here, did it do it on this day yet? No. The market opens on this day, rallies back above this high. What is this high right here? Okay, what is the high on that candle? The high on this candle is 131.33. The high on this candle comes in at 131.29 and 2 pipettes. So when price goes above this, right as it goes above that, what is that as an entry? It's the institutional order flow entry drill technique. So when we see price trade above that, this is all fair value gap. All of this move here is a CIBI, sell side imbalance, buy side inefficiency. When this candle closes, if we trade to this candle's high or above it, that could be a sell, because the context and framework is we're looking for a run below this low here and potentially filling in the fair value gap that resides over here down into the candle high at 130.11 and 4 pipettes. The low comes in on this at 129.90, so it certainly went down into it. So I want you to go into the hourly chart with me here and take a look at what we've seen. This is that previous Wednesday's high, and Thursday we traded up into it on New York. Now I gave a little bit of a review in chart form. Let me just keep it like this, that way it's nice. Relative equal highs, left the highs intact in London with no real reason to stop right here except for the rejection block, but it's so clean. That was a trap. Okay, price sells off. Yes, it takes the sell side liquidity and then runs it on the rate announcement. So we have the New York session market reversal, and then it runs back below and goes into that 130.11 handsomely, which spreads down into the big figure, and it dips below big figure to 129.90. And if I'm not mistaken, it goes to 89, doesn't it? No, I'm wrong. 29.90. Price makes an attempt to get back up into Wednesday's low, moves up a little bit into that range, and then just loses ground on the weakness of Eurodollar in sympathy, and also with the strength in the dollar. Really sloppy lows in here. It looks like we'll probably press lower. How much lower, I don't know at this moment, but it depends largely on what the dollar index does. Going into a 15-minute time frame, and we'll zoom out just a little bit. Okay, you can see a real nice fair value gap in here. Now again, this blue line, that's Wednesday's daily low. Now, if you remember back on Baby Pips, back in 2010, I stated that your study should show a sensitivity to previous days' highs and lows. Now, how far do we look back? Well, you can go back as far as you want in terms of the IPTA data ranges. Okay, we talk about that. But for near-term intraday volatility, which is not dependent on a directional bias, you can do scalps just on this basis alone. The last 3 days, so count today, okay, go back 3 days. So today's day 1. Go back yesterday's day 2. The previous day is Wednesday. That's day 3. That's how I look at it. That's how I view it. Now, if you use yesterday as day 1, and then Wednesday day 2, Tuesday would be day 3, you're not going to get that much of a difference in terms of sensitivity. I'm just telling you that the way I've done it, it's today's day 1, yesterday's day 2, previous day is day 3. And what I'm doing is I'm trying to participate in the swing highs that would form, because it takes a 3-candle pattern to create a daily swing high or daily swing low. You can see the fair value gap overlaps with the Wednesday's daily low, which is that blue line. That's all this blue line is it's denoting the Wednesday's low. And this was Wednesday's high. And price went above it, rated it, went below it, rated it, and then created a fair value gap at Wednesday's low. Price rallied up, and then it expands down to the 130.11, and then subsequent 130 big figure, and then dipping below it by 10 pips, which is classic. And then we have an ugly market condition. This pair is being held in consolidation to allow euro pound to drop. And I'll leave that for your study between yesterday and today. Look at your daily 1 hour and 15 minute time frame for euro pound to see why that pair did what it did. And that's why euro dollar really crashed today in comparison to what British pound did. All right, so a really light weekly review. I kind of want to go into this with low energy because it's time to wind down for the year. My mind, honestly, is so preoccupied with the festivities of the coming weeks. So I really want you all to understand that my time will be spent with all that. I won't be trying to do too many email responses. In fact, I probably won't be doing any unless it's an urgent thing. Just be patient. Okay, if there's something that's really pressing, just understand that this is a very important time of the year for me, family-wise. In the last 2 years, I worked through these weeks, and I hated myself for it and not staying true to what I've done for years, not doing anything. And I understand this is a business. I understand this is a service that you pay for, but I'm a human being with a family, and this takes a lot of my time, and I just simply can't do all that with the family element that's required around the holidays. So I'm collectively asking all of us to just relax and enjoy the next 2 weeks and understand that the markets are really not ever really in a position where you have to be in the marketplace to be trading right now. It's not there. Okay, so we want to relax, get our minds ready for a new year, and then the whole month of January is a gradual sticking our toe in the water type thing, but no real engagements until February. Okay, so all we do is we study what sentiment is building in January, which is the first month of the year. Every single year, that month sets the stage for what is likely to occur for the rest of the year. Many times it can be a Judas, and other times it can be just a continuation of an underlying theme. So there's a lot of turmoil around the U.S., and it's going to be heavily weighted on the dollar as a result. So I'm hoping that we'll get to some closure on the impeachment, and hopefully they get through that. But it doesn't appear that's going to work like that. And I think we'll probably have a very messy political calendar all through 2020. But the wonderful thing is that's going to create pockets of volatility. So when they come in, it'll be real aggressive surges higher or lower in these currencies. And those create imbalances. And then we have really easy salad days to trade. We wait. We don't push it. We don't try to get aggressive about making the setups come. We're going to be following seasonal tendencies. A lot of commodities next year We're going to be doing a lot more of that, and you'll see when we don't work too much in currencies, we'll be able to do other things with index futures and like agricultural markets and financial markets, like the bond market and such. So we're going to look into a little bit of diversity in speculation, and that way you'll see that what you're learning here just simply is not a Forex trick. Okay, it's not a gimmick that works in Forex. There's a lot of things that are very specific about Forex, and I make those very clear and apparent when they're there, but largely all of the things that you're learning from a price action view works on all asset classes, and it's a very empowering state of mind once you understand that and you believe it wholeheartedly. There's no reason for you to worry about Forex, being messed with or preventing you from ever making a career out of it, because you can make a career out of any asset class. You could do it with stocks. And I think that's going to be it, folks. I just want to take a minute to thank you all for trusting me as your mentor. I put a lot into this, and it's wonderful to get feedback. And I'm not asking for you folks, I'm not trying to tug on your heartstrings to send me emails, because I have a lot of emails and it's just going to add more to it. If you want to just wish me, a sense of appreciation, or if you just want to wish me well for the holidays, a simple tweet to me will be sufficient. I would appreciate that. But try not to fill my inbox up in my email, because I have a lot of them still to go through, and I just opened the floodgates for the 2020 enrollment, and I told everybody to email me, a week before the 27th, and everybody emailed me right away, which I kind of expected. If I was honest with you, I expected that to happen, but it's easy to sort through my emails. I can take all those and move them to the side and still keep in sync with what has already been sent to me once we get through the holidays. But as a reminder, there will not be any videos next Wednesday or next weekend or the following Wednesday. But the following weekend, that's when we'll be returning back to. And just so you guys understand what I mean by this, so I'm not confusing anyone. Okay, here's where we are today. The 25th is Christmas. There will not be any video there. I'll put a chart up on something of importance that maybe is a lesson or something in that. The 27th, there will not be any video commentary. And January 1st, which is New Year's Day, there will not be any recordings there because my wife and I will be away. The 3rd, I will be returning back to weekly commentaries. So then the weekly commentary for that week will start back here, and then the following week will be a midweek review again, and then we'll be back in sync. Okay, so that's how we're going to do it from now on. I'm not working through the weekend, the weeks of the holidays anymore. I'm not doing it. So, and the other one, just I want to throw this in there because I've been doing it too through the mentorship. I generally don't do anything either the week of Passover, so there won't be any recordings. People in the United States call it Easter. I don't call it Easter, but it's Passover. That week is important to me, and I regretfully worked the last 2 years through those weeks too. I won't be doing that. So that way you know my calendar, you know what I'm going to be putting out and what I'm not going to be putting out any content in the mentorship, and I think that's reasonable. If you have opposition to that, you're just going to have to accept it, because I'm not going to change, and this is the way it's going to be. And I think, like I said, I think it's fair. But ultimately, you have the decision in that. If you want to complain, you're welcome to complain, but I'm not going to change. All right. So, in closing, I wish you all a very, very warm and memorable Christmas, and may your family and your friends delight in your company. May the year 2020 bring you prosperity and good health and high spirits, and just a greater sense of independence, the pursuit of that. And it's my goal and it's my wish that all of you have a profitable, empowered 2020. God bless all of you, and have a Merry Christmas.